Hello everyone and welcome to Lesson 8 of our Real Estate for Beginners crash course. Today we'll be diving into Module 4, Real Estate Financing, Lesson 2, Real Estate Taxation. Our learning objectives for this lesson include understanding the basics of real estate taxation, identifying different types of real estate taxes, analyzing the tax implications of different real estate investments, and developing a tax strategy for a real estate investment. Let's start with the basics of real estate taxation. Real estate taxes are a crucial aspect of real estate investing. It is essential to have a clear understanding of the tax implications of different real estate investments to maximize your profitability. Different types of real estate taxes include property taxes, transfer taxes, and income taxes. Property taxes are taxes levied on the ownership of real estate, and the amount of tax is based on the assessed value of the property. Transfer taxes, on the other hand, are taxes paid when a property changes ownership. Finally, income taxes are taxes paid on the income generated by the real estate investment. Now that we know about the different types of real estate taxes, let's analyze the tax implications of different real estate investments. Owning different types of real estate investments has different tax implications. For example, owning a rental property generates rental income, which is subject to income tax. However, owning a commercial property generates rental income, which is not subject to self-employment tax. Let's take a look at some real-world examples. Let's say you own a rental property and a commercial property, and the rental income from both properties is $10,000 per month. The rental income from the rental property is subject to self-employment tax, which means you will have to pay 15.3% of your rental income in taxes. However, the rental income from the commercial property is not subject to self-employment tax, which means you can save 15.3% of your rental income in taxes. As a real estate investor, you can also take advantage of tax deductions and credits to reduce your tax liability. Tax deductions are expenses that you can deduct from your taxable income, such as mortgage interest, property taxes, and depreciation. Tax credits, on the other hand, are dollar-for-dollar reductions in your tax liability, such as energy-efficient home improvements and low-income housing. Now let's move on to our activities. We'll calculate the tax implications of a hypothetical real estate investment and develop a tax strategy for a real estate investment. Let's assume that you bought a rental property for $200,000 and rented it out for $1,500 per month. You paid $10,000 in property taxes and $5,000 in mortgage interest for the year. To calculate the tax implications, we'll need to determine the taxable income from the rental property. The taxable income is the rental income minus the deductible expenses, such as property taxes and mortgage interest. Rental income per year equals $1,500 x 12 equals $18,000. Deductible expenses equals $10,000 plus $5,000 equals $15,000. Taxable income equals $18,000 to $15,000 equals $3,000. Now that we know the taxable income, we can calculate the taxes owed. The tax rate for rental income depends on your tax bracket, but for simplicity, let's assume a 20% tax rate. Taxes owed equals $3,000 x 20% equals $600. Therefore, the tax implications for this hypothetical real estate investment would be $600 in taxes owed. Now let's move on to the second activity, which is to develop a tax strategy for a real estate investment. Developing a tax strategy for a real estate investment involves maximizing the tax deductions and credits available to you. Here are some tips. 1. Keep track of all expenses related to the investment property, including repairs, maintenance, property taxes, and mortgage interest. 2. Depreciate the property over its useful life to deduct a portion of the cost each year. 3. Take advantage of tax credits such as energy-efficient home improvements and low-income housing credits. 4. Consider forming a real estate investment trust, REIT, to take advantage of additional tax benefits. By implementing these tips, you can lower your tax liability and maximize the profitability of your real estate investment. The discussion question for this lesson is, what are some tax deductions and credits available to real estate investors? And how can a tax strategy be used to maximize the profitability of a real estate investment? There are many tax deductions and credits available to real estate investors, including 1. Mortgage interest deduction. Investors can deduct the interest paid on their mortgage for their investment property. 2. Property tax deduction. Investors can deduct the property taxes paid on their investment property. 3. Depreciation deduction. Investors can depreciate the value of their investment property over time and deduct a portion of the cost each year. 4. Home office deduction. Investors who work from home can deduct a portion of their home expenses, such as utilities and maintenance. 5. Energy efficient home improvement tax credit. Investors can receive a tax credit for making energy efficient improvements to their investment property. By taking advantage of these deductions and credits and developing a tax strategy, real estate investors can lower their tax liability and maximize the profitability of their investment. In addition to these deductions and credits, real estate investors should also consider the tax implications of different types of real estate investments. For example, owning a rental property may result in higher taxes than owning a property for personal use. This is because rental income is subject to both federal and state income taxes, as well as self-employment taxes. On the other hand, investing in a real estate investment trust, a REIT, may provide additional tax benefits. REITs are companies that own and manage income-producing real estate properties and are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. As a result, investors may receive favorable tax treatment on the dividends received from a REIT. Overall, developing a tax strategy is an important part of maximizing the profitability of a real estate investment. By taking advantage of available deductions and credits, considering the tax implications of different types of real estate investments, and staying up to date on tax laws and regulations, real estate investors can minimize their tax liability and maximize their return on investment. In conclusion, real estate financing and real estate taxation are important modules in any beginner's crash course on real estate. Understanding the basics of real estate taxation and identifying different types of real estate taxes are crucial in making informed decisions when investing in real estate. By analyzing the tax implications of different real estate investments and identifying tax deductions and credits available to real estate investors, one can develop a tax strategy that maximizes the profitability of their investment. Congratulations to all of you for completing the Real Estate for Beginners crash course. I hope that you have gained valuable knowledge and insights into the world of real estate. Thank you for taking the time to learn and invest in your education. I wish you all the best in your future real estate endeavors. Remember to continue to learn, stay informed, and make informed decisions when investing in real estate.